Let's talk interest rates. More signs of an economic slowdown yesterday make at least 2 more interest rate cuts this year a near certainty. There's nothing pointing to a recession. However, the slowdown from recent highs is starting to look more pronounced than appeared even as recently as a month ago. GDP growth of 3% a year for the next 3 years, forecast by both the Treasury and the Reserve Bank in late autumn, now looks more than heroic. Annual GDP growth can now be expected to slow to 2 to 2.5%, with a dip below 2% now much more likely than not. Again, it's not a recession or anything like it, but after the 3.5% growth of recent times, it will be a significant come down. The Reserve Bank has little to worry about on the inflation side. Yesterday's CPI was at the lower end of forecasts, taking the CPI to 0.3% for the year, and underneath the hood, the data is even more benign. Non-tradable inflation is the lowest level since December 2001. In fact, if the tax-driven increases in tobacco prices are excluded, price inflation fell 0.1% for the year. Petrol prices fell 7.4% for the year. Electricity prices showed a zero increase for the year, something that has not happened for 15 years. The Reserve Bank will review the OCR next Thursday, and a second cut of 0.25% following on from last month is as near a certainty as it's possible in this area. A further cut when the Reserve Bank releases its next full monetary policy statement in mid-September is also an unusually strong bet. How far and how fast the Reserve Bank goes will be strongly affected by how the exchange rate adjusts to the slowdown. Two dairy-related headlines, the nearly 11% drop in the global dairy price plus job layoffs at Fonterra, highlight the headwinds now being faced by that sector. This is going to have a flow-on effect on the rest of the economy. Last week's NZIER quarterly survey of business opinion showed retailers decidedly downbeat about their prospects for the year ahead, with retailers in high dairying regions such as the Waikato and Taranaki being the most pessimistic. Consumer confidence figures released yesterday hold no good news either. Although a good proportion of people say they're better off than a year ago, their view of prospects for the year ahead turned negative for the first time in 3 years. Regional North Island took the biggest hit again. This is an obvious flow-on from the dairy price fall of the past 18 months. That survey, of course, was done well before Wednesday night's GDT price fall. The significance of yesterday's figures is simply that the expected bottom of the fall is yet to be reached. Harbour Asset Management strategist Oivan Rimmer says the latest drop is truly awful. The latest fall implies a spot farmgate milk price of $3 a kilogram per milk solids. It's not likely to stay that low over the season, he says, but Fonterra's forecast of $5.25 is now under threat. Not all economists are quite so pessimistic. ASB Bank's Nick Tuffley says the current season will still be hard. He forecasts a payout under the Fonterra number and picks a $4.70 payout, but says next season should still see a rebound as the Chinese economy picks up from its current slowdown. With this in mind, he said we expect the 2015-16 milk price to rebound to $6 a kg. Nor was all the economic data yesterday bad. The performance of manufacturing index, or PMI, rose on last month and continues a 33-month expansion. The survey, an international benchmark, reported a number of negative comments, but these are focused entirely around the dairy sector and its effect on rural spending. New orders and hiring are both expanding, and Bank of New Zealand economist Doug Steele says that sector, although subject to greater volatility, is still very much in growth mode. In receivership news, another women's clothing chain has gone into receivership, this time the Identity clothing chain. A statement from McGrath Nicol says William Black and Kerr Johnston have been appointed receivers to Winters Fashions, which trades as Identity. According to its website, there are 15 Identity stores around New Zealand, 6 of them including an outlet store in Auckland. The website is advertising a 60% off sale. Mr. Black says in the statement the stores will continue to trade while we work with Identity stakeholders, management and staff over the coming days to stabilise operations, to facilitate a thorough assessment of the company's financial position and to prepare the business for sale. The Identity receivership follows the news last month that the Shanton women's clothing chain was going into liquidation and the remaining 18 stores would be closed. The company had 37 stores when it went into voluntary administration in January. Also last month, the iconic Wellington department store, Kirkcaldy & Staines, which has dominated Wellington's premier shopping street Lambton Quay since 1863, will close next year. Last year, the listed Postie Plus Group went into voluntary administration after its bankers pulled the plug and was later sold to a South African retailer. And JK Kids decided to close its stores in late 2013 after 18 years. Other retailers, particularly in the clothing field, have been doing it tough, including listed companies such as Hellenstein Glasson Holdings, widely regarded as being one of the best operators in its business, Pumpkin Patch and The Warehouse. In business news, loyalty scheme software provider Collect has become the first Kiwi company to integrate with iPhone app Apple Passbook. Passbook is an app embedded in all iPhones to keep things like movie tickets, retail coupons and loyalty cards in one place. Apple recently announced Passbook will be rebranded Wallet when the iOS 9 is released and will incorporate the Apple Pay system, which lets people digitally pay using their iPhones. However, few people outside the US know much about it, and there are no companies in New Zealand using Passbook to promote offers. Collect says this is why it got involved. Small businesses can put content into Passbook through Collect's app, which is already integrated, without having to go through the integration process themselves. It envisions that when a customer of a small retailer which subscribes to Collect visits that retailer, their iPhone will remind them to redeem rewards. The Wellington-based software startup, which made a loss last year of just over $796,000 on turnover of $166,000, terms this a major step in its international growth push. The company, founded in February, has 800 users in 60 countries for its cloud-based loyalty and marketing software. Chief Executive Brent Spicer expects 2,000 paying customers within 12 months, with the break-even point at 5,100. Collect, valued at $8 million, has secured more than $2 million of investment in the past 2 years and plans to raise further capital from US institutional investors by the end of the year. The company is running an equity crowdfunding campaign through Crowdcube, which is managed in New Zealand by investment bank Armillary Private Capital. There has been $379,700 raised from 33 investors so far, and the offer remains open with the hope of reaching $1 million in return for 11.11% of the company. The management team board includes Peter Biggs, chairman of the Wellington Regional Economic Development Agency, ex-Xero executives Paula Jackson and Paul Williams, ex-Google executive Kyle Enright, who is based in San Francisco, and co-founders Matt and Brady Thomas.
Join NBR's Intelligent Business Network today. www.nbr.co.nz/subscribe. NBR.
This is NBR Radio on Friday, July 17th. I'm Owen Poland. Canada has been described as a toxic mix of a resource economy that's blown apart, sitting on top of a housing bubble. In his editor's insight today, Neville Gibson draws parallels between New Zealand and Canada. So, Neville, what's the state of the Canadian economy?
Well, the official figures aren't out yet, but it may already be in recession. Canada had a drop in its economy in the first quarter this year, and everyone, including the Reserve Bank there, called the Bank of Canada, says that we're likely to see a further fall in the second quarter. So 2 quarters of negative economic growth add up to a recession, anybody's definition book. And as a reaction to this, the Bank of Canada yesterday cut its official cash rate to just 0.5%. Now, back at the beginning of the year in January, it cut the interest rate to 0.75. It was quite worried about the economy at that time, but no one was even thinking of a recession. But that was a reaction to the low oil prices on which the Canadian economy is heavily dependent. So the parallels with New Zealand is that around about that time, at the beginning of this year, the Reserve Bank of New Zealand was actually increasing its interest rates, and in response to what they thought was going to be an overheated economy and rising inflation. But of course, subsequent events have proved that wrong. We had an interest rate drop just a week or so ago, and we're going to likely to get one next week, but we'll still be well above the interest rates in Canada at 0.5%.
So you mentioned oil, which is obviously a critical part of the Canadian economy. How did this decline, this rapid decline, come about?
Well, they're talking in Canada of how can you go from a boom to a bust so quickly, and oil prices have, of course, slumped quite heavily. Canada is 77% dependent on its exports of oil. It's had a high currency as a result. That currency's come down. In fact, the currency tracks the oil prices quite closely, and that's really unfair because it ignores, as it does, as the currency traders do in Australia and New Zealand, that we have quite substantial economies that aren't just dependent on commodities. For example, Canada's got a sophisticated industry, very good infrastructure, high degree of education among its people, and it's been described as a bit of a catch-22 because if the currency traders keep the dollar up and you've you can't make your industry more competitive, and Canada has its challenges in that area from trade unions and high cost of labour, then you get caught there, where the currency stays up, your exports fall, and then you've got all these people borrowing in housing, which is the other big issue in Canada.
Yeah, well, let's look at the parallels once again. What's the state of the Canadian housing market?
Well, it's been booming for some time. In fact, the government there has taken measures over recent years to try and keep a cap on it, but the prices have now gone well over $1 million for a single dwelling in both Vancouver and Toronto, and a lot of this is driven by both locals borrowing at low cost, you're talking very low interest rates, but you've also got strong migration into Canada, and household debt there soared as a result, and so the Reserve Bank in New Zealand, as in Canada, have to weigh the risk to the banking system of a collapse in those house prices versus keeping the economy going. Now in New Zealand we've done the opposite of what Canada has just done. The Reserve Bank Canada there, Stephen Pollis, yesterday announced that they were going to cut the interest rates in order to restore the economy and try and get those depend on more of those exports, the non-oil ones of course, and make Canada slightly more competitive. We're doing the opposite, but I think the Reserve Bank is possibly coming around to the Canadian point of view, and that the housing bubble is likely to stay there for a while yet.
Have you looked, incidentally, into the influence of Chinese migrants on the Canadian housing sector versus New Zealand's?
Well, it hasn't been quite phrased in that terms, because obviously in Toronto there's pressure of immigrants mainly from other parts of the world. Canadians find that the Chinese have all headed for Vancouver, but they don't go across the other side, whereas Toronto and that get immigrants mainly from Europe and Africa and the Middle East, that sort of thing. But one thing that's common about all migrants is they do want to buy housing.
Indeed. You say in your insight that Canada has a poor export performance. Why is that?
Well, this has been looked at quite closely by a number of institutions in Canada, including the Centre for the Study of Living Standards, and they blame two things, or three things really, but one of them has been the weak demand from the US. Now, they were expecting at the end of last year that the US economy would pick up quite strongly this year, but of course we had that big winter slump there, and the Canadians have suffered the worst of it, and their exports were really quite highly priced. Now, it's part of a big free trade market with Mexico, which was undercutting Canada in a lot of things. So the Canadians have actually lost big market share. The only exception is motor vehicles. But generally speaking, exports fell a total of 6.7% on an annual basis after peaking in July last year. So they've come down quite a bit. Now, the biggest drop of that was oil, which has dropped by about a third. But even so, if you put all the other categories, food and manufactured goods, all that sort of thing, you're talking about a drop of about 3%, and that's quite severe.
Now, there's an election looming in Canada later this year. What are the future prospects, do you think?
Yeah, the interesting thing about Canada is that it has what you might call a centre-right government led by Stephen Harper. It's been in power for some time. It got a majority at the last election 3 years ago. There's one due in the middle of October, and he's got along very well with John Key. I think they see eye to eye on a lot of things, and you could probably throw Tony Abbott in there as well. So these are all right-leaning governments. They are all quite reformist-minded, and they'd like to open their economies up even more, but they've hit a barrier of public opinion. And in Canada, that has moved quite strongly against the government. The provincial government in Alberta has always been a very right-wing one, very pro-business and open market, but it lost the provincial election to the New Democrats, which came from nowhere. The New Democrats are virtually unknown in rural parts of Canada because they basically, like the Labour Party here, but much more left-wing and very anti-free trade and protectionist, not just trade protection, but also union jobs. So you've got Canada's most right-wing province going left, and I suspect that's going to happen in eastern Canada as well.
Interesting times for Canada and, dare I say it, interesting times for New Zealand as well. That's Neville Gibson's Editor's Insight.
NBR Radio with Hotel de Brett, partying since 1959. www.hoteldebret.com. NBR Radio.
In today's NBR print edition, Inland Revenue's high-profile $2 billion ICT business transformation project is only the most visible point of an extremely large changing iceberg of how government is done in New Zealand. Rob Hosking talks to some of the people who are not so much driving the changes as surfing the shift in public attitudes causing the changes. The Court of Appeal has reversed a lower court decision that could have affected insurers' decisions to protect businesses against criminal conduct. Fresh details have emerged about a controversial share sale in a Canadian food giant by its New Zealand-based heiress. Like MediaWorks, Maori Television has recently copped criticism from many quarters. How justified is it? Finalising the Trans-Pacific Partnership may come down to the wire this month, but the question of what to do with China if the deal passes is already being discussed. A war of words has broken out between high-profile economist Shamabeel Yaqub and former Reserve Bank official Michael Riddell over immigration figures. In Neville Gibson's Margin Call column, he discovers recent truck movements show a declining direction for freight transport. Is a 5-year TY option hanging over the Kiwi Rail network? Shujine says Fonterra's Chinese investment is cause for concern, and dairy prices hit a new low. Will they go lower still? All this and more in today's National Business Review, out now. To wool, New Zealand wool prices rose at the latest auction as a decline in the local currency made it more attractive for overseas buyers. According to AgriHQ, the price for clean 35-micron wool, a benchmark for crossbred wool used for carpets and accounting for the majority of New Zealand's production, rose to $5.90 per kilogram at yesterday's South Island auction from $5.75 in last week's North Island auction and $5.80 at the previous South Island auction, which was the last of the 2014-15 season on June 25. The price for lamb wool held at $7.20 a kg for the third consecutive auction. New Zealand's currency has fallen sharply over the past week as traders price in increased interest rate cuts as dairy prices remain lower for longer, weighing on the nation's economic growth. At 8 a.m. on the morning of this week's sale, the Kiwi was trading at 65.92 US cents, 2% below its 67.27 cent level a week earlier. AgriHQ analyst Emma Dent said the lower New Zealand dollar saw most wool types increase at the second auction of the 2015-16 season. Some 7,942 bales were offered for auction yesterday, with an 88% clearance rate, the first dip below 90% since March. Next week's North Island sale includes 6,000 bales, 32% less than anticipated after poor weather delayed shearing. Let's talk disputes. Carrickmore Nutrition Managing Director Chris Claridge is at loggerheads with a joint 50% shareholder in the business as it looks to embark on a lucrative new export opportunity in China. Mr. Claridge and US-based Karen Grace Inc. appeared briefly in the Wellington High Court on Thursday for a hearing relating to an appointment of an interim administrator, according to court records. However, Mr. Claridge told NBR Radio the proceedings were dismissed with costs reserved. He said, "I can't go into details other than the proceedings were dismissed. It's an internal shareholder issue and the hearing was over very quickly." Mr. Claridge and his wife Carol own 50% of Carrickmore, an infant formula and nutrition export company based in Paraparaumu. Karen Grace Inc. is listed as owning a half share in the company on the company's office website. It's understood that Karen Grace, based in California, is owned by wealthy private individuals with links to China. Carrickmore has been exporting infant formula and related products to China for about 4 years, but suffered a setback 2 years ago when the botulism scare halted the company's growth, taking 6 months to recover. Asked whether the dispute with Karen Grace has been resolved, Mr. Claridge said, "I doubt in the long run. One day I'll sit down and tell you about doing business in China." He then revealed that Carrickmore was about to open a new office in China and had just secured export rights to China for one of the largest infant rice cereal factories in Australia. He said no one has managed to successfully export rice cereal from Australia to China. He said, "We're commencing that, which is a bit of a coup." In terms of scale, he says the output of the factory, which he didn't identify, is 3,500 tonnes of rice cereal. That converts to a capacity of 28 million packets of rice cereal, which sells at about $8 a packet, he said. So you can see why we think it's a coup. He added the first production run started yesterday. He said there are two types of infant formula, dairy-based and cereal-based. Everyone focuses on dairy-based infant formula. We are the master distributor in China, so we've taken control of the distribution chain. So while not being specific about yesterday's court hearing, that might indicate what yesterday's fight was about.
This is NBR Radio on Friday, July 17th. I'm Owen Poland. The high-profile technology company Vend, which is known for online retail and point-of-sale software, has confirmed to NBR Online that it's laying off staff. But how many and what's it all about. Joining me is Campbell Gibson. Campbell, what more can you tell me about Ven's restructure?
Well, not a heck of a lot, to be honest. They're being pretty coy, but Vendor's often in the media, it's a very high-profile company because it's often compared to Xero, and that it's very focused on international expansion, rapid expansion. And it says in this recent news, it's shifting more of its focus to the international markets, where they have about 85% of their revenue coming from there. So they have offices in Auckland, Wellington, San Francisco, Melbourne, Toronto, and Berlin. So, they cover most parts of the globe, I guess, at this point. And just over a year ago, they told NBR that they had about 172 staff. So what that number is like now, they haven't actually gotten back to me yet, unfortunately. But they wanted to double that by the end of this year. So, wanted to double that by this time. So whether they've achieved that is, whether they get back to me or not.
Well, obviously it's a changing world in terms of retail and the online business, and they, just last month announced a deal with Apple, which is not insignificant, I guess.
Yeah, that's right. So it's not every day that a business gets to do a deal with Apple, and having their software promoted in all the bricks and mortar stores in Apple throughout the world is definitely going to help their profile. So, I wish them all the best, because you definitely don't want to see companies like this start to slow down when they're doing so well.
Now, the founder and chief executive of Vendor, Vaughan Rousel, I think told you that they grew revenue by 1,100% in its first 3 years. But some of our readers are a little bit sceptical, judging by the response online.
Yeah, I think there was one saying that, how can you grow 1,100% when your revenue would start off a 0% base? So I'll leave readers up to, I'll let readers make their own minds up over what they think of that line.
Yes, it's a question. I mean, this is obviously, there's a lot of blue sky here. It's a matter of figuring out how much is maybe hot air as well.
Yeah, well, I guess the reality of these sort of things comes down on companies, and this is what they have to do to try and free up a bit of expenditure.
Yeah, well, it's a company you'll obviously be keeping a watch on, Campbell.
You're listening to NBR Radio. Upgrade to My NBR Radio with a smartphone-only subscription to NBR Online today for free, and receive unlimited access to NBR Online on your smartphone until August 31st. Visit www.nbr.co.nz/free.
In People News, Shamabeel Jacob is leaving the New Zealand Institute of Research, where he's been principal economist for the past 6 years. Mr. Jacob says he wants to do something else now following the birth of his 7-week-old son. He said, "I want to spend a bit of time being a dad. There's no big rush. It's a pretty special time." For the next little while, he doesn't want to have to commit to deadlines and the other pressures of full-time work. Mr. Jacob says, "My broader plan is I would love to have a portfolio of governance roles and advising businesses." Institute Chief Executive Lawrence Kubiak says the organisation will miss Mr. Jacob. He says he's been an excellent colleague, an incisive and insightful thinker, and a trenchant and vivid writer. Mr. Kubiak says Mr. Jacob is still in his 30s and his wife has just had his first child. He's a young fellow. He's not going to be in one place for all his career. Young people aren't like that these days. The thing that's really affected his thinking has been the coming of his first baby. We understand completely how he feels. Mr. Jacob had already reduced his role at the Institute 6 months ago when he handed over his member services role to Christina Lang. Mr. Kubiak says whatever Shamabeel does next will generate interest. I'm just very glad that while we will miss him, this is a very cordial parting of the ways. Mr. Jacob hit the headlines regularly as presenter of the Institute's much-watched quarterly survey of business opinion. He has already altered his LinkedIn entry to show he left the Institute last month and that his current positions include Aotearoa Development Cooperative, a charity providing microfinance to projects in Myanmar and Malawi, and he's an investor in Monto, a company providing insurance product development technology. Mr. Jacob says he became involved in the charity through his friendship with its founders, Auckland solicitor Andrew Colgan and Jeff Cooper, who used to be chief economist at Auckland Council. He says, "I love the idea of microfinance because it's a great way to help people. It's a hand up, not a handout. ADC is doing some cool stuff. The results are just phenomenal, and the difference it makes to people's lives is just phenomenal." Mr. Jacob and his wife Selina are the authors of a recently published book, Generation Rent, which looks at the declining rate of home ownership and argues for better conditions for tenants. He says they really loved putting the book together, and he'd like to do more work on such social economic issues.
This is NBR Radio on Friday, July 17th. I'm Owen Poland. Netflix, the United States provider of on-demand internet streaming media, has reported a quarterly profit of $26.3 million. That's down from a year ago's quarter of $71 million. However, revenue rose from $1.3 to $1.6 billion. Joining me to take a deeper look into the financials is technology editor Chris Keel. What did you glean from the result?
I've seen yet another huge quarter. They've gained millions more subscribers and tens of millions more in revenue to $1.6 billion for a single quarter. So they're just as big as the big US mainstream free-to-air broadcasters now. That sort of money. But it's the old issue which we've seen quarter after quarter for Netflix, which is it actually began as a DVD rental business in the US, and it's still the dirty old DVDs, which contributed $77 million in profit. So without that, they'd have actually been in the red.
Fascinating stuff.
Yeah.
What about the Australasian business? How's that going financially?
So of course, Netflix launched here early this year, and I met with some Netflix people last week, and they would not say how many New Zealand or Australian subscribers have had, and with all their spreadsheets and their letter to shareholders and guff that they released with their quarterly profit today, they would not reveal anything specific either. They said it was going great. But we have had a couple of surveys in Australia. Roy Morgan has done one, and it says there's just over 1 million people viewing Netflix. Doesn't try and ascertain how many are subscribers, so there'll be some multi-people households there. And then, so that's roughly 10 times the second tier, which includes Foxtel service and QuickFlix and others. So we're not sure if those are very ballpark numbers, but it does seem that of the avalanche of streaming video services that have launched there, Netflix is the most popular. And we've seen Horizon do a similar poll here, and it's found an even more exaggerated ratio there, picking 220,000 Netflix viewers, and they put QuickFlix back on 25,000 and Neon on 16,000. So,
are you able to glean any kind of feel for the uptake from the bandwidth use?
Yeah, since January we've had Chorus, which controls most of the network, report a 40% increase in data traffic, and Spark say that their traffic's up about 30%, and they've all sort of reinforced their networks, and it seems to have evened out now, apart from a few people in Wellington and Christchurch. But that's been the biggest indicator that people are watching these streaming video services, and it seems from the surveys that most are gravitating towards Netflix, though we haven't seen a good number for Lightbox, so we're expecting one on August 31 when Spark reports. But the thing too, I guess, is that a whole bunch of them are on free trial offers at the moment. Lightbox is free for a year, and a lot of people who are Vodafone customers have got 6-month free Netflix trial periods, and the others have got 1 month. So we've sort of things have yet to kick in at the hard end when people have got to start paying for it.
I was interested in the graphic on your article online indicated over the past 5 years in the United States, their peak download traffic rose from 21% to 30%, so 50% gain. They're getting traction. How are they going against the competitors, against the likes of HBO?
The figures that they've provided from an independent outfit called Sandvine show Netflix accounting for 36% of all internet traffic now in the US, so that's huge. And their rivals like Amazon Prime and Hulu are on 2% or below. The next biggest. YouTube is still far smaller. So yeah, it seems to be doing there. And it's quite notable too that Netflix traffic is far larger than BitTorrent traffic now, BitTorrent being the most popular pirate service. So just shows that if you give people the option, most will pay.
That's great, Chris. That's technology editor Chris Keel.
NBR Radio with Bayleys, New Zealand's leading commercial real estate company.
This is NBR Radio. I'm Owen Poland, and welcome to our weekly macroeconomic roundup with reporter Jason Walls. And Jason, I know we've spent the last couple of months talking about Greece, but we're moving on.
We are.
And the focus in this part of the world, at least, is now shifting to China.
Yeah, I mean, there's still obviously things happening with Greece, but I thought we'd just cover some other things that are happening this week. And yeah, as you said, China. Now, China's the big one to watch because obviously we've had the stock problem within the last couple of weeks. We saw it go astronomically high from the beginning of the year and then plummet about 30% in the space of a month. So, I mean, obviously that's a shock to the world markets. And I've said it before and I'll say it again many times, when there's a ripple within the Chinese economy, we feel waves all over the world. However, what we've been seeing is that Chinese exports grew for the first time in 4 months. So it's actually some kind of positive news coming out of China right now. So it rose roughly 3%, so about 2.8 on a year after dropping about 2.8 in May, as you'll remember that we talked about earlier in this year. And this beat expectations for it to decline about 0.2%. So it's looking good. However, it is worth mentioning that imports have slumped about 6.1%, although that represented an improvement from the plunge of 18.1 previously, and it wasn't as bad as it was forecast at negative 15. So things are actually kind of looking good. However, the weak imports indicate that domestic demand kind of remains tepid and adds to the feeling that the central bank could further loosen monetary policy. I mean, we've seen 4 rate cuts already in the space of about 6 or 7 months. And that's a lot of stimulus within the economy. And you're seeing that these figures are probably going to add more calls for more liquidity, more rate cuts, and things like that. And it's worth mentioning as well, these trade figures were well ahead of Wednesday. They were ahead of the GDP data that was released on Wednesday.
So we had good news there. I mean,
yeah, again, actually,
GDP,
staying on the good news theme out of China, so it's quite nice, isn't it? That we were expected to see that GDP growth was supposed to slow to about 6.8%, so dipping below that magic 7 number that they've been forecast on staying at the whole year, where actually we got the bang on 7% number. So we saw that GDP rose, as I said, 7% in the 3 months to June, making it more likely the country will hit its 2015 growth target of 7%. So it's good. That China are sort of, I don't know how to say it. They're kind of doing okay. They're not too great, they're not too bad. They've had some ups, they've had some downs, but we still have this headline figure of 7% GDP remaining on track. So, as I said, we're going to have to wait and see about the liquidity and the stimulus within the Chinese economy. But at this point, things are looking not too bad.
Yeah, seems a long time ago that China had double-digit growth, Jason.
Gone are the days of the 14% GDP growth.
Exactly,
that's for sure.
Exactly. You're listening to the Macroeconomic Roundup with Jason Walls. Turning to the US, what's happening with interest rates there? Because that economy seems to be just slowly but surely picking up.
Yeah, and this is one of my favorite macroeconomic stories of the entire year. You won't believe that of how often we've talked about Greece, but this is actually my favorite story of the year because you've got this. The US is huge. It is basically one of the world's twin engines of economic growth. We've got China and the US, of course, and we've seen rates at record lows since roughly 2008. I think it was October 2008 or something like that, where they kept them at rock bottom levels because of the GFC. And as you'll know, they kept them at this level to encourage investment, encourage spending, et cetera, to add more stimulus into the economy. However, we've got to a point where the US are going to have to up those rates because of just all the data that's coming out of the economy and how they just need to do this, and how Ms. Yellen has been signaling this for a long time. So the news this week is that Ms. Yellen, who is obviously the chairwoman, signaled that the recent turbulence in Greece and China and elsewhere overseas isn't actually threatening the U.S. economy enough to divert the Fed's plans to raise its interest rates later this year. So a lot of Fed officials have indicated that this is going to happen in September, and a lot of analysts have been picking that this is happening in September as well. However, I mean, it's still hugely split. That's the thing with these. Nobody knows for sure, and all the analysts and all the economists will change their mind at the drop of a hat when it comes to different data coming out. So it's always to take this with a grain of salt. But that September period is actually looking quite likely. You'll remember that we talked about earlier this year that the IMF said that this isn't the time to raise rates. We've actually got to wait next year, I think it was. But that it doesn't look like Ms. Yellen is being given that a whole bunch of time, and it looks like the rates are actually going to go ahead. We'll have to wait and see, though.
You're listening to NBR's weekly macroeconomic roundup with Jason Walls. Closer to home, the Reserve Bank has a meeting later this month. Things are moving rather quickly now in the New Zealand economy, especially after this sharp plunge in dairy trade prices. Now there's talk of, and the currency's fallen, talk of, maybe more rate cuts. Things are happening in this economy.
Absolutely, and it's amazing how quickly things turn around. I mean, we got 3 or 4 months ago, I was in here in the studio, I was in the newsroom writing about how New Zealand's economy is actually doing well. We're forecasting GDP growth ahead of most OECD countries and stuff like that. But we've seen, especially within the last month and a half, that confidence and just the whole outlook has really turned around and shifted. We've seen farmer confidence go down, consumer confidence go down, business confidence go down. We've seen a cut in the interest rates, and we've seen a lower forecast for GDP as well. So what this is all kind of pointing to is what analysts have been saying for the last couple of weeks now, and that is there is almost 100% chance that the Reserve Bank is going to cut rates within the next when their next meeting is later this month. So I was talking to Tim Kelleher earlier on the week when we were doing our currency talk radio show, and he said that about 24 out of 25 basis points have been already factored in, and there's going to be a huge cut. Now, the interesting thing about this that I found is what range the cut's going to be, because obviously when you think about a rate cut, we see traditionally they're usually around 25 basis points, so that's about 0.25%. We've got Westpac actually coming out and saying that financial markets currently pricing in 25 to 50 basis points of the OCR cut in September are actually kind of wrong. And we need to be looking a lot higher. And they've made quite a big call in saying that we should think about pricing about 50 basis points or even 75 basis points worth of cuts. And that's reflecting the risk of the Reserve Bank, just basically what's happening within the New Zealand economy right now. So that's a huge call. Because, I mean, you think people are calling for about 2 or 3 more cuts towards the end of the year, and they're saying we're going to have this mammoth cut right now. And then it's going to be interesting what happens. We know that it's going to happen, but by how much? And that's the question.
Well, we'll be watching that space with great interest, Jason. That's our weekly macroeconomic roundup with Jason Walls.
NBR
Radio.
Free to air online. NBR, the meeting place of intelligent business.
In employment news, high-profile tech company Vendors confirmed to NBR Radio it's laying off staff but won't say how many. The cuts will mainly affect New Zealand staff. Founder and Chief Executive Vaughan Rousel says the company is making the changes as part of our international high-growth strategy, he said. Just last month, the retail software developer announced a deal with Apple that would see its apps promoted in bricks-and-mortar Apple stores worldwide. Mr. Rousel says 85% of the fast-growing company's customers are offshore, but the majority of staff are in New Zealand. To continue our rapid international growth, he says, we've made the decision to invest more in our key markets of Australia, UK and North America, which means reductions in other parts of the business, including some redundancies in New Zealand and consolidating our Berlin office into London. He says the changes will put the company closer to its customers and strategic partners such as Apple, Mercury and PayPal. Mr. Rousel says we've built an amazing team, and while it's hard to let good people go, we're still totally committed to New Zealand, with more than 100 people across Auckland and Wellington, including all our R&D activity, with plans to grow again in the future. He says in our first 3 years, we grew revenue 1,100%, with over 100% year-on-year growth over the past 2 years. To the market, Z Energy shares fell as much as 3% yesterday after the company released quarterly data showing it continues to lose market share and that industry volumes are weak. Z shares fell as low as 564 from 581 on Wednesday, but recovered to end the day at 574. The figures show Z Energy's total fuel volumes fell to 27.4% of total industry volumes in the June quarter, from 28.4% in the March quarter, and from 28.4% in the June quarter last year. In volume terms, Z's fell to 539 million litres in the June quarter from 634 million in the March quarter and 657 million in the June quarter last year. Z's chief executive Mike Bennett was unavailable to discuss the latest fall, but in November last year he said the petrol station operator's retail pricing strategy had changed in the face of a really hot market amid rife discounting. Z's volumes had fallen 4% in the 6 months ended September against an industry-wide rise of 1%. Previously, Z had been more standoffish in the face of discounting to maintain its profit margins. Mr. Bennett said then, "We think we have a premium offer. It's something that people really value, and we felt that was deserving of where we're positioned in the market. But the difference between us and some of the competition in a small number of markets around New Zealand is just too great to tolerate." Z decided it needed to become more aggressive to protect its market share, and that it had started competing through discounting in selected markets. In May, Mr. Bennett said the year ended March had been the most competitive year in Z's history. Forsyth Bar analyst Andrew Harvey-Green says the latest volume numbers are uninspiring, but the important thing is Z's margins are holding up. Mr. Harvey-Green says the volumes, yes, they're down a little bit, but this game's more about margins than it's about volume. Diesel volumes were hit the most in the latest caller, falling 6.2%, and he attributes that mostly to the loss of a couple of commercial contracts. Overall, he says, falling market share and a slowing economy are both factors in the weaker volumes. The figures showed industry margins rose to 32.4% from 31.8% in the March quarter for petrol and to 39% from 36.9% for diesel. Mr. Harvey-Green says the good news for Z in the June quarter is New Zealand refining. Z owns just over 17% of New Zealand's only oil refinery. He says New Zealand refining reported 2-month margins at the US $9 a barrel cap for some customers, one of which we assume is Z. Mr. Harvey-Green has modified his earnings forecast as a result of the latest volume figures, but the impact has been largely offset by the better contribution from the refinery. He's cut his forecast for normalised earnings before interest, tax, depreciation and amortisation by $1 million to $254 million for the year ending March 2016, but a $4 million increase in his forecast earnings from associates. The refinery means his forecast normalised net profit is up $2 million to $139 million.
This is NBR Radio on Friday, July 17th. I'm Owen Poland. House prices are a result of immigration blunders of our governments, according to former Reserve Bank Executive Michael Riddell. Joining me for more on that story, I'm joined by Nathan Smith. You've had a long chat with Mr. Riddell, I gather.
Yeah, he's quite adamant that there's a lot of, not misinformation, so to speak, but just perhaps we're focusing on the wrong things. There's maybe ambulance at the bottom of the cliff stuff in regards to the prices. Comes from a decades-long, multiple governments issue of just finding ways to change things that obviously, like chaos, have effects down the end that you aren't expecting. One of those is happening now with house prices. Immigration especially, this necessity for some reason to get target immigration levels just leads to more people. And unfortunately, coupled with that is his second point, where they both collide together, where the regulation policies for freeing up housing so that these immigrants can actually buy houses seem to come into clashing there as well. But there's a lot of talk around immigration there.
Yeah, let's separate out those two issues and just talk a bit more about the immigration side of things. I mean, it comes and goes in terms of the floodgates being opened and closed, but they have been open for a while. And of course, also we're attracting high value, high net worth individuals as well, who have to put up $10 million, and they've got to put it somewhere, and they're putting it into housing. Go figure. So he's saying that if you bring in all these immigrants, there's going to be an inevitable demand for housing. That's right.
They tend to gravitate to Auckland as well. I think the government knew that. And obviously when you travel to another country to live, you want to be with people who you find affinity with. And I think that's something that was inevitable in New Zealand as well. But unfortunately, the policies have changed over the decades, and it is not just one part of the political spectrum that is to blame necessarily. He says, Mr. Riddell says, for this, it's bipartisan. It's between both sides, and it just seems to be just poor foresight, really.
And in terms of the planning, resource consent, dare I say it, side of things, what's his view there?
Well, interestingly, it's the attitudes, it's the policies, it's the slow, not keeping up with reality things that a lot of people have complained over the years about. Especially when you're trying to pull consent for a subdivision in Auckland, the common refrain is that this just takes forever. Why does it take forever? And then the reason comes back, and it seems petty. And there's just interesting stuff that goes on with that. But he says those two things together have created was essentially a perfect storm here.
And it shouldn't be difficult when you think about it, in 2020 hindsight, matching up immigration policy with housing policy in terms of central and local government working together to say, hey, this is where this policy, these are the outcomes that we're heading to.
Back a couple of decades ago, closer to sort of the mid-20th century, New Zealand was probably closer to a planned economy than it is now. And of course, looking ahead, you set yourself goals. And these target ideas, these quotas, they come from that sort of mindset. And so the central planning concept, which still is rife in councils across New Zealand today, is sort of a progeny of that. And I think that's something that he's calling for to be reassessed as to how you deal with the long-term implications when you're making decisions on policies. Maybe that needs to change as well.
So how's the Auckland Council responded to his line of thinking?
Well, very similar to that, really. I mean, Chris Parker, he's the Auckland Council chief economist, says that they've actively staged the release of land to ensure 7 years' supply at all times. But I mean, the response to that from Mr. Riddell was that clearly there's something happening with land prices. You can tell that, but the response is simply to say, no, we're organising ourselves on a 7-year plan basis. Seems to be missing the reality a little bit, that things are happening too quick for attitudes from a central planning perspective like that.
And Mr. Riddell has drawn an interesting comparison between Auckland and Houston, of all places.
Yeah, and he also mentioned a number of others as well, but technically speaking, he's probably right to point out Houston because it's doubled in population, yet the house prices have fallen. And that's the opposite to what's happened here. And there's a number of other cities where the planning and the immigration has happened far quicker than in Auckland, and yet we're the ones sitting out as outliers in regards to house prices. And he says maybe we can learn some lessons looking back at those particular cities around the world.
Nice to see some light in this very heated debate, Nathan. That's NBR reporter Nathan Smith.
NBR Radio. With Clooney Restaurant, an unparalleled private dining room choice. NBR Radio.
This is NBR Radio. I'm Owen Poland, and welcome to the political and economic week that was with Rob Hosking. Rob, and turning to the economy, obviously the major news this week, that massive fall in the global dairy trade price to a 6-year low, which has significant implications for Fonterra and our economy.
It certainly does. That was a 11% drop in this week's global dairy auction. That's nearly a 20% drop since May, and a few months back, the expectation was that things would be starting to bottom out with this dairy price by now. If you extrapolate through this week's dairy price, if it stays this low, then Fonterra is actually looking at a payout probably below $4 a kg. I think the current payout is forecast is it's a little bit above $4 a kg, and there were some calculations I saw suggested it could go as low as $3.25, and that's highly it's unlikely to go that low, but we're almost definitely, I would say, looking at a revised downward forecast for the dairy payout for the current season, which of course only started in June. And Fonterra will probably, I understand, issue a revised forecast at the end of this month. They may hold off for revising it down just yet, but that's, I guess, the detail. The bigger picture here is lower earnings for New Zealand, and we saw the New Zealand currency take some of the impact on that. Now, don't forget, if the currency does adjust downwards, that will to some extent offset this fall. The question is, and you never know with exchange rates, is how far it will adjust. This week, the New Zealand dollar actually didn't fall as much as perhaps you might expect, or a lot of us would have expected, given that price announcement. But there may be more to move on that front, and that will be actually less dairy-related or even New Zealand-related, but the US Federal Reserve starting to normalise their interest rates a little bit more, and there's expectation shifting there this week as well, which is probably going to that will pull the US dollar up, and the global dairy trades in US dollars. So the main thing here is that the New Zealand dollar will fall a little more and take some of this impact.
I imagine I imagine the mandarins at the Reserve Bank will be sharpening their pencil too, Rob. And I mean, some economists this week have been predicting a 50 basis point cut very soon.
Yeah, I doubt the Reserve Bank will do that. Governor Wheeler does review the official cash rate next Thursday, and yeah, I think that I'd take it as a given that there will be another 0.25% cut. I know some people are suggesting, look, he could go 0.5%. That could be premature for a couple of reasons. Firstly, we don't know how much the New Zealand dollar will take out of this as well, and that will, if that does adjust enough, and it is finally, moving downwards back to where it should be, given our economic fundamentals, then he won't have to cut so much. In fact, he wouldn't want to, because you're going to overshoot at the other end or undershoot. But the other factor there is that because the Reserve Bank moved a little bit too quickly last year in hiking interest rates, there's a lot of debate amongst economists about how the Reserve Bank dealt with things last year. But one thing I think most people are agreed on is that they moved too far too fast, and they won't be wanting to repeat that this year.
You're listening to the Political and Economic Week that was with Rob Hosking, and there we have a number of releases out this week on the statistical front, inflation figures, also manufacturing data and consumer confidence. What was your take on all that?
Yeah, these are, I guess, a reminder that the New Zealand economy is not just milk, and working them in order. Inflation is minimal. On an annual basis, it rose 0.3%, which is actually less than what most people were expecting. So, if you're looking at the Reserve Bank's situation, that actually does give them a little bit more room to move, given that inflation is so minimal. And in actual fact, if you take out non-market factors, the big one being tax price hikes or tax-related price hikes on tobacco, annual inflation was actually negative. We actually had deflation if you take out that excise price increase back in March. So, look, there's no inflation to worry about. And at the same time, we do have growth. And it's, although obviously GDP growth is going to be coming off 3.5% we saw more recently, I doubt it's going to drop. Well, it's not going to go into recession, barring a real shock from somewhere. And even though these dairy prices are bad, it's not bad enough to put us there. And the other factor is that, as I say, other things are happening a little bit less bad. We had manufacturing data this week that showed things are actually still performing quite strongly in the manufacturing sector. Some of that is construction related, because a lot of our manufacturing sector supplies the local market. But also with the New Zealand currency coming off, that's going to help our manufacturers who are exporters, particularly into the Australian market.
You're listening to the Political and Economic Week that was, and switching to politics. The major talking point has been dominated the headlines, offshore investment and allegations of racism after Labor, of course, suggested that most of Auckland's real estate was being snapped up by Chinese buyers.
They really screwed this up, whether deliberately or whether whether it was just a screw-up, although it's a pretty big screw-up. Look, here's how you could structure the argument here without having to raise the issue of racism. And you go back to basics. Point one, the Auckland property market is overheated and has been for some time. Everyone knows that. The house prices are just insane. Point two, a lot of factors are driving that. The big one is shortage of supply. There are other factors relating to that around regulation, resource consents, the unitary plan, all those sort of council-related things. There's a tax issue, certainly. There is a immigration or net migration issue, where you've got fewer people leaving Auckland for Australia than we've had since I was still in nappies almost. And there's in turn internal migration, as always, going to Auckland as well. And you've got immigration coming from overseas. The other thing is the global picture here is we've got minimal global interest rates. In fact, a lot of countries have negative real interest rates. If you're an investor, and you've got a more risk-averse world, if you're an investor looking for a safe investment, which is going to get you a good yield, it's property. And where is that property? It is property in cities with good infrastructure, in countries with good governance, with reasonably good economic growth prospects, and where supply is already constrained, because that is going to push up prices. And so you have money from all sorts of investors flowing into New York, London, Sydney, and Auckland, and a lot of less well-known places.
So
that's the economic issue.
Yep. Carry on.
You can build a case around that without having to go through electoral rolls and say, okay, this person is called Lee, therefore they have a 40% chance of being Chinese, and just getting into that whole ugly, ugly issue.
Of course, the person...
And I don't know why they didn't do it that way.
Yeah, the person who fronted this was a fellow called Phil Twyford, Te Atatu MP and Labour Party's housing spokesman. If anybody hadn't heard of him before, they certainly know who he is now.
That's right. And I think it was calculated politically as a ploy for the disgruntled New Zealand First voters, or Labour voters, people who voted for New Zealand First. New Zealand First got 9% at the last election. A lot of this is dominating quite a bit of our politics at the moment, the war, what I call the war of the Winston succession. Winston Peters turned 70 in April. He'll probably fight one more election, but I doubt he'll do two more. And the question is, what happens then to the people who have flocked to vote for him? He has the star factor, and nobody else in NZ First does. The other factor is the other leadership issue, a more imminent one, is Labour's internal politics around the deputy leadership, because currently Deputy Annette King has said she'd only do a year. She'll be 70 at the next election. She said she doesn't want another term, and they plan to have a leadership election towards the end of the year for that. So this is Phil Twyford positioning himself for that. West Auckland aspirational voters are where New Zealand elections are won and lost these days. It's sort of moved north from Hamilton. The Hamilton seats in the old system used to be the bellwether seats where Hamilton West or East went. These days, it's those voters in West Auckland, and national strategists will tell you that where that moves is very much where the country goes. And Phil Twyford was in the catbird seat for all that. Now, I suspect, in fact, I'm damn sure that his gambit here has been so divisive within Labour, he's pretty much cooked his goose. But you'd be extraordinarily naive not to think that this was a factor which drove this particular splash.
And that's the political and economic week that was with Rob Hosking.
NBR Radio. Free to air online with business news you can use.
In media news, broadcaster and columnist Jessie Mulligan is to host the afternoons program on Radio New Zealand National. The slot used to be held by Simon Mersep, who was confirmed to have left the public broadcaster last week. Head of radio John Howson said he expected the former 7 Sharp host to bring a new and exciting flavour to the afternoon show. We're thrilled that Jessie is joining us. He's done a great job filling in on afternoons in the past, and listeners can look forward to his invigorating, fresh approach when he starts as the permanent host on Monday, July 27. Mr. Mulligan started out in student radio while completing his law degree at Waikato University. He spent 10 years as a commercial radio breakfast host in Wellington and Auckland. He writes restaurant reviews for Metro, hosts the late-night TV1 comedy show Best Bits, and does stand-up comedy, among other jobs. His column in the Sunday Star Times was recently replaced by David Slack. Mr. Mulligan says he's looking forward to bringing a new perspective to the afternoon slot while upholding the excellent traditions of New Zealand's favourite radio station. To Z Energy. Z Energy's Chief Executive Mike Bennett says the company's gradual loss of market share highlights how competitive the fuel business is. and should bolster the company's application to the Commerce Commission to allow it to buy the Caltex assets. Mr. Bennett says this is as relevant to our operational performance as it is to our application to the Commerce Commission. At one point in Zed's reporting history, before we became a listed company, we had something like a 33% market share. Currently, we have about 27%, but our profits are much greater. But much of that business wasn't profitable. He says our market share moving like that is a good example of how competitive the market is. People look at our acquisition of Chevron, the owner of the Caltex assets, and see the combined 48-49% market share, and they find that very disturbing. But looking at the gross figures for the national market is misleading, according to Mr. Bennett. Yesterday, Z released figures showing its total fuel volumes fell to 27.4% of total industry volumes in the June quarter from 28.4% in the March quarter, with actual volumes declining to 539 million litres from 634 in the March quarter. Mr. Bennett says his company lost a contract to supply an airline at Auckland Airport in the quarter, and that accounted for maybe 20 million litres. He says that will show up in our market share figures, but that business was barely profitable. As well, a couple of businesses Z supplied went into receivership, though they had no bad debts owing to Z. Another business switched to another supplier, but again it was barely profitable, Mr. Bennett says. He says Z could have won other business in the commercial space, but chose not to take it on because the available margins were insufficient. To the dairy industry, Fonterra Director of Cooperative Affairs Miles Hurrell says yesterday's decision to axe more than 500 jobs was far from a knee-jerk reaction. This follows Fed Farmers Dairy Chairman Andrew Hoggard saying yesterday that he hoped the job cuts are part of a broader strategy to redirect resources in new areas rather than a knee-jerk reaction to cut costs as dairy prices continue to fall. He said Fonterra has a history of knee-jerk reactions like this, where it gets rid of a whole bunch of people and then 2 years later hires them back again, or rather having got rid of people with institutional knowledge, they hire new graduates who can't do as good a job. But Mr. Hurrell says the headcount reductions are just a small part of the overall piece of work that he says is going to streamline, optimise better efficiency across our entire business. He adds it's important to note, while we're talking staff cuts today, the program is wider than headcount reductions and covers the end-to-end of the business and what is needed to generate more value for shareholders. Mr. Hurrell confirmed the cuts to the staff would primarily come from New Zealand staff in HR, information systems and finance. He says the next phase is other parts of our business, including marketing and communications, and we'll start to engage with those people as we go. Yesterday, the dairy giant announced its plan to axe 523 jobs as part of a business review. The review includes measures to improve profitability at Fonterra's Australian business, as well as a series of additional measures to remove barriers across the organisation to enable it to unlock more value. At that level, the co-op expected continued payroll savings of approximately 55 to 60 million a year. The job losses came as world dairy prices continue to sink, with prices in the latest GDT auction falling 10.7%, the lowest level since July 2009.
NBR. Need to hire? Try our online recruitment platform, www.nbrtalent.co.nz.
Market news. Michael Hill International is being buffeted by Australian headwinds, although kinder weather in other markets is lending a sparkle to the business. The Brisbane-based jewellery retailer announced this morning it had increased full-year sales 3.4%, with sales rising to $495.6 million Australian dollars in the year to June 30 from $479.3 million a year earlier. Shares increased 2% to 102 since the announcement, although has decreased 18.6% in the past year. Australia is Michael Hill's key market, making up about 70% of store earnings before interest and tax. The company has previously warned economic weakness there due to commodity export prices dropping is likely to weigh on full-year earnings due for release on August 14. The latest figures confirm slowdown in this market, with sales dropping 1.4% over the year and by 2.5% on a same-store basis. Harbour Asset Management analyst Craig Stent says Australia continues to remain a soft market. In my opinion, it continues to remain a difficult market for retailing. He says there is also evidence of a fourth quarter slowdown in the New Zealand market, despite full-year sales rising 6.7% to $106.2 million or 7.2% on a same-store basis. But Nikko Asset Management analyst Michael Desesare says even though the Australasian retail industry is under enormous pressure, Michael Hill has produced another year of revenue growth as well as continued store openings. He said despite the headwinds faced by many Australasian retailers, such as leakage to offshore merchants and bricks and mortar entrants, the company continues to navigate through the challenges, executing on their growth strategy. The group opened 12 Michael Hill stores during the year and closed 2, taking the total to 288 stores, and added 2 Emma and Rose stores during the year, taking the total to 8. Michael Hill is investing for future growth by developing its e-commerce channel and spending on promotions, particularly in the US. The group is also refining and testing the Emma and Rowe retail model, and consequently this trading update did not include financial information for those stores. Today's figures show its Canadian business is gaining traction, with sales jumping 15% to $81.3 million, or 3.1% on a same-store basis. In the US, sales increased 25% to $13.6 million, or by 14% on a same-store basis. Michael Hill did not give earnings guidance today, but warned in April a drop in Australian same-store sales in the first 9 months, and now a further drop in the fourth quarter will put pressure on its full-year result. Forsyth Barr downgraded its Michael Hill earnings forecast last month due to concerns about the Australian retail backdrop. Analysts now expect full-year earnings before interest and tax of 43 million Australian. In market news, Steel and Tube Holdings shares rose after the country's biggest steel distribution company said it's agreed to buy fastener distributor Manufacturing Suppliers for $32 million in a cash and scrip deal. The company said in a statement it will pay $26 million in cash and $6 million in shares for Auckland-based MSL, which is best known for its Fortress Fasteners brand, which Steel and Tube will keep, along with continuing to operate the business under the Manufacturing Suppliers name. Chief Executive Dave Taylor told Business Desk the acquisition will be funded through Steel and Tube's existing facilities, and the company will provide more details once the transaction is completed in the next 6 weeks. Mr Taylor said the issue across the broader steel categories in New Zealand is that there's just far too many players, and it requires some consolidation in what's a relatively small market, and we've been looking for opportunities for a wee while. They, referring to MSL, would be regarded as the leaders and the preeminent fastening business, so we're going to bring into Steel and Tube a good business with a good set of customers and a set of competencies across the staff. And we'll look to expand those capabilities and expertise across the existing fastening business we have in Steel and Tube, and look to leverage the combined business to go to a new level. The acquisition is Steel and Tube's second in the past 15 months after it bought Tata Steel Australasia for $28.1 million, which helped lift the company's first half earnings 35%. Mr Taylor said Steel and Tube is still interested in acquisitions, but that the company won't buy for the sake of buying. The shares rose 5.7% to $279, recovering some of the 12% decline since June 11, as volatility in steel markets and weak iron ore prices weighed on the stock. Grant Williamson, a director at Hamilton Hindon Green, said the acquisition will go some way to soothing nervousness about the company's exposure to global steel markets. He said investors will like the fact they're diversifying a little bit more. Steel and Tube's Mr Taylor said the global steel industry is contending with significant Chinese production and cheap iron ore prices, though the recent depreciation in the Kiwi dollar had gone some way to mitigating that. MSL has 8 branches across the country and employs 100 staff. It stocks more than 200 million items and has 10,000 product lines. General Manager Steve Williams said MSL will be a good fit with Steel and Tube, which is a supplier to many of the company's suppliers. Mr Williams said in an emailed statement, "We look forward to strengthening the relationships with those customers and working with S&T. It's business as usual with MSL operating as a standalone division of S&T Fasteners." In media news, Radio New Zealand says it will disestablish 20 jobs and create 6 new ones in the next 6 months, resulting in a net loss of 14 staff. Spokesman John Barr says the news team will not be affected and the staff reductions will mainly occur in features, concert FM and drama departments. Just last week, however, afternoon host Simon Mersep left the broadcaster. RNZ employs 281 full-time staff. It will shift the focus of its operations from Wellington to Auckland. Mr Barr says the Wellington office will probably be reduced from 3 to 2 floors. The restructure was centred on focusing on RNZ's digital platforms and was led by Head of Content Carol Hirschfeld, who joined the organisation in September last year. Mr Barr hinted that there could be further staff reductions in future months, saying operating costs will have to be constantly monitored if there is no increase to funding. The broadcaster hasn't had an increase to its $35 million government funding for 7 years. Mr Barr says the broadcaster will spend $10 million on capital expenditure over the next 10 years, mainly on upgrading its equipment. In a recent interview with NBR, Chief Executive Paul Thompson explained how the organisation is spreading its wings with investment in video and youth-targeted platforms, but a lack of further funding is putting on the pressure. Mr Barr says Radio New Zealand is exploring commercial opportunities, but it's restricted by its commercial-free mandate. Its expansion onto external platforms such as iHeartRadio and MSN could provide extra income, but he says they're so small it's not even worth mentioning. Mr Barr provided some stats about RNZ's website traffic. This year, users on radionz.co.nz are up 75% on the same period last year, with 3.31 million users. May was the biggest month yet on radionz.co.nz, with more than 900,000 users, a 110% increase on the same period last year. The Wireless, Radio New Zealand's youth website, has had 1.57 million users to date in 2015, compared with 105,500 over the same period last year, a 1,395% increase.
NBR. With a National Business Review smartphone subscription, you can read or listen to the latest from NBR online. And for a limited time, it's free. Join NBR's Intelligent Business Network today and get free smartphone access to NBR online until August 31st. NBR doesn't do sport, weather or horoscopes, just timely, relevant, useful and insightful business news. So for business news you can use for free, visit nbr.co.nz/free.
To Auckland house prices. According to former Reserve Bank executive Michael Riddell, house prices are a result of immigration blunders of our governments and just a choice. He says house prices floating into potential bubble market territory are a result of bipartisan blunders by the New Zealand government. The problem comes from an eminently unworkable immigration system dating back decades. If New Zealand wants to get serious about the house problems in Auckland, he says, lowering immigration levels should be done tomorrow. Mr Riddell says we should think more seriously about reducing the target immigration level. If we halve the level of non-New Zealand migrants, it would take a lot of medium-term pressure off the housing market. Auckland house and land prices are expensive due to the collision of two sets of policies, he says. On one hand is the central and local government laws, policies, attitudes and practices of bringing new houses to market. Coupled with this are the immigration policies that actively bring large numbers of people into the country every year. Today, the target level of non-citizen immigration is set by Immigration Minister Michael Woodhouse. New Zealand aims for 135 to 150,000 immigrants on a rolling 3-year basis, or 35 to 50,000 a year. As a result of that target, New Zealand has among the largest rates of inflows of non-citizens in the OECD. According to Stats New Zealand, the bulk of those non-citizens gravitate to live in Auckland. Mr Riddell says in the mid-1970s this country changed its immigration policy. The British no longer had automatic access, migrant numbers plummeted and a large outflow of New Zealanders to Australia began, which continues today. It didn't last too long though, because in the late 1980s, early 1990s, immigration was opened up considerably again. He says the policy was reshaped with a sensible move to a points and skills-based system for capable people. There wasn't much debate about the appropriate rate of immigration or of what the implications might be. It just happened. People who were involved tell me there was a strange sense that perhaps the government had to act to replace the people who were leaving to Australia. For more on this story, nbr.co.nz. To log prices. New Zealand export log prices were unchanged this month amid uncertainty about the outlook for China's economy. The average wharf gate price for New Zealand A-grade logs held at 86 a tonne in July from June, according to AgriHQ's monthly survey of exporters, forest owners and sawmillers. The AgriHQ log price indicator, which measures average log prices weighted by grade, fell to 89.17 from 89.38 last month, led by declines in domestic log prices. Log exporters have been optimistic that prices would pick up after falling to a 3-year low of 83 a tonne in May, as Chinese sawmillers started to make inroads into log inventories at the country's ports. Still, the outlook for demand in China, the country's largest market, remains uncertain, according to AgriHQ. AgriHQ analyst Emma Dent says market participants are expecting some price increases through August and September. However, they're not overly confident in the recovery. She said slower demand from China over their summer months will help reduce inventories on Chinese ports, which still remain at high levels. Demand from China is typically lower in the third quarter heading into the country's summer season. Log inventories at Chinese ports currently sit at about 3.8 million tonnes, down from more than 4 million tonnes earlier this year, but higher than a normal level of about 2 million. Prices for New Zealand domestic logs were mixed. Structural log prices edged lower to 106 a tonne from 107 last month, while demand for structural wood remains strong due to a housing shortage. Building activity slows during winter months and there are large volumes of lumber in the market, according to Ms Dent. Meanwhile, pruned log prices increased to 163 a tonne from 161 last month amid tight supplies in the central North Island, which saw North Island logs fetch a premium of 165 a tonne compared to the South Island price of 151. Most market participants are expecting that demand for pruned logs will continue to outweigh supply, which will put upward pressure on prices, according to Ms Dent. Logs, wood and wood articles are New Zealand's third largest commodity export behind dairy and meat. The value of wood exports fell 16% to $3.45 billion in the year through May, according to Stats New Zealand. The latest trade figures for June will be published next Friday. In court news, Auckland financial advisor and former Sunday Star Times finance columnist Andrew Robinson has been sentenced to 6 years in jail. He was found guilty in the Auckland High Court of 5 serious fraud office charges of theft by a person in a special relationship relating to his role with Strategic Planning Group and convicted. Robinson stole investor funds of approximately $2.7 million to repay the investments of other investors and to pay for some business and personal expenses between 2010 and 2012. He made false statements in various investment reports to hide the true picture from investors. The investigation began in December 2012 when the FMA received a complaint with allegations about Mr. Robinson's management of client funds. The FMA referred the Crimes Act issues to the SFO and the agencies conducted parallel investigations. Robinson still faces charges laid by the Financial Markets Authority under financial markets legislation.
NBR Radio with Baileys, New Zealand's leading commercial real estate company.